I'd like to begin with a bit of more about what you do. So in no particular order, I'm going to ask you just about your role in your respective institutions. Sharmila, Nasdaq was really a tech marvel when it launched 50 years ago. Can you believe that? February 8th, 1971 to be exact, as the world's first electronic stock market. Can you give us an idea of your role there?
Sure. So in the vein of the technology and innovation, and we got to hear a little bit about that from the QQQ as well, Nasdaq focuses on the technology and data that investors are using. So in my role as head of asset owner solutions, I'm working with RIAs, OCIOs, high net worth, family offices, as well as the large institutions and sovereign wealth funds globally to try to help them invest using technology and data. And I know we're going to get into that conversation today, so it'll be exciting to share notes.
Yeah, in a little bit, I'm going to ask you how you manage those relationships. Vincent, Voya's foundings were tied to insurance, something that the younger generation does not think about very often as much as they should, and certainly not something that we associate with technology. So tell us about Voya's transformation from this ING subsidiary to actually an IPO.
Yes, good morning. It's really been a fantastic, interesting ride from, as Janet mentioned, being a bank-owned insurance company to a more independent health, wealth, and investment manager. We serve over 14 million institutional, individual, and workplace clients. So certainly a long way from just the insurance business. I think the way it touches all of those clients really is through 401ks, health savings accounts, mutual funds, ETFs, and so a much broader array of products and solutions for clients. So it really has been quite an evolution over the past decade.
Brooke, Fidelity is a third-generation financial giant in our respective hometown of Boston. It has also undergone extraordinary innovation. Give us an idea how technology is leveraged by and for the individual investor, since that is your area of concentration.
Absolutely, and good morning, and thanks for having us. At Fidelity, to your point, we've been blessed. We recently celebrated 75, now going on 76 years being in business. And part of that in business, we serve 35 million customers. We also serve 23,000 additional businesses through employer benefit plans and support another 13,000 financial institutions. We, on average, invest about $2.5 billion in technology on an annual basis, and 25% of our workforce and growing is actually in the business of software engineering, digital engineering, design, architecture, and creating product. We would be remiss to say that the entire business is fueled by technology, and when I say that, that for us really means two things. One is technology that serves the individual investor, all of our digital channels. But given that we believe very much, as we talk more about personalization today, in both the human channel as well. So that's also technology that our associates and client-facing advisors are using. So pretty significant. And in my role as Chief Information Officer, I'm really blessed to have an incredible team that comes in every day figuring out how can we serve that diverse customer base.
And speaking of the customer base, Fidelity, I know, saw a huge increase in new accounts that opened, especially during the pandemic, as most institutional investing houses did. We'll go into that in a little bit, but Shar, I want to come back to you to ask you about those customers. Can you give us an idea of who those institutional customers are and how you service them increasingly using technology?
Sure, so happy to. At Nasdaq, when I talk about allocators and asset owners, what I'm speaking about are the pensions, this university endowments, the RIAs that I know some are in the audience and across the Bloomberg network. So we're looking at all different types of allocators who are looking to work with asset managers as well as get into the capital markets through either public or private investments. We have about $2 trillion under analysis in that realm. And with that, we try to remember exactly who they're also serving, giving them tools so that they're pursuing their missions, whether it's a retirement, or actually sponsoring something for research and an endowment.
Speaking of retirement, which is something that we all think about, and actually, as we learned today, even the younger investors are starting to think about this earlier, which is only good for them. I'm going to ask Vincent a question, but feel free to jump in. Vinny, you, of course, service a lot of 401k retirement plans. What do you wish would be different or improved with that investment vehicle?
Well, we've seen a lot of improvements even over the past few years from things like automatic savings rates and automatic enrollment, customized advice for 401k participants, the potential use of other vehicles like annuities in those plans, and sustainable investing. So there's already been a number of innovations. I think one of the things that I'd like to see is continued flexibility for our 401k clients, where they have sort of more flexibility to go sort of outside even the investments that as we go forward, we're going to see a lot of those kind of enhancements as they go forward.
Now, I know that each of you in your roles, you're not responsible for personal interaction directly with your customers. But since we are talking about the next generation of investors, I'd like to ask each of you if there's something that you see or that occurs to you that actually makes this newest generation different from, say, the current and legacy investors.
Yeah,
Anything come to mind?
I'm happy to start with that. It's a total passion point for me personally. One of the things that I observe, this particular generation at Fidelity, when we say young investors, what we're talking about is really that demographic that spans between 18 to 35. So that's going to be Gen Z, Gen Y, a little bit millennial. One of the most socially conscious, financially curious, well-educated generations. Now, no doubt, they're growing up in a proliferation of technology availability that other generations didn't have. So it means education's much more accessible. But the actions that we're seeing in this generation in terms of not just getting educated, but actually taking the action to get invested, to be curious about planning, to be, we've talked a bit about today in terms of how to balance, it could be student debt and also, that first sort of significant purchase, whether it's a car or, your next degree. It has been really striking for us.
And we also know that Fidelity, I think fairly recently, allowed a much younger class to open accounts. There are appropriate guardrails. I think you need the adult over 21 to be a co-manager, but something that we wouldn't have thought about at 14 or 15. Shar, what are some of the things that you're observing with the younger investors?
Sure. So I think we see it, and actually I get the chance to talk to investment teams who are often, the intergenerational wealth is changing. So when you're looking at family offices, you've got investors that are of this generation, and they're trying to think through, because they are the I generation, they've always grown up with data and technology being at their fingertips, how they actually are taking investments and transparency and looking at data in ways that we could only hope to do because of the development of technology in such, the recent several years. I think the other thing that we're seeing too is that they're demanding certain things. So we've talked about sustainable investing for decades. I know as an institutional investor myself, we were always trying to look at that both from a risk management or even leaning in for returns. But I think what you see now is you're seeing investors coming up looking for certain types of impact or mission they can do. And so anything from investing in diversity or investing in governance, we're seeing a lot more demand, and we're seeing that translate from this younger generation.
Vinny, I know that you're going to answer this question, but I also want to bring in, because you do a lot with artificial intelligence, and I know that this is something that's a word that's still intimidating to a lot of people of a certain age, and it's something, though, that the younger generation and even other ages, they're being more comfortable with it, and they realize that it's going to be a part of how we invest in the future.
Yes, and I think, so my role is to oversee our equity investments, so whether, again, they're mutual funds or institutional accounts. My background is more in quantitative investing, so I've always used data and technology and modeling to help make investment decisions for our portfolios. I think what we've seen really in the last decade is the influence of AI, machine learning tools, to further enhance that capability and allow us to hopefully make better decisions for our portfolios and generate outperformance. So just as an example, Janet, a couple of years ago, we acquired an AI machine learning firm and brought them on board. And what we've seen in the couple of years they've been there is not only can they generate better returns and than we could have previously in our quantitative investments, but they work very closely with our fundamental teams who manage money in a more traditional style, and even our quantitative teams that have more model-driven. So I think the proliferation of AI in the investing world is incredibly important. I think it's just going to continue, and I think it's going to be a benefit for investors for a long time.
When I introduced the event this morning, I talked about that we would look at different asset classes and what all generations are finding interesting. We got a great question from the audience for all of you. Since future investors want to invest in private markets, what makes a successful private market? And I think I'm going to start with you, Shar, because he asked, why did Nasdaq get out of private markets?
So we did get out of certain aspects of the private markets business, as some people know, and there was a spin out. But we're actually very much involved. Much of the data that I collect through eVestments and Solovis, which is a platform for portfolio management, is based on the fact of using public market and private market data and helping you understand portfolios. We also have other aspects of Nasdaq where we're looking into, again, along the same themes here about how to make information accessible across stakeholders. So in the private markets, for secondaries, we're actually developing platforms where we can help asset managers and investors come together. And that also translates from institutional investors across to retail, because we know there is a desire for many to diversify their portfolios. And now with the use of technology and being able to scale, we're able to do that in a way that wasn't possible before for retail.
Mm-hmm. Brooke, I want to ask you, during the pandemic, as I referenced, Fidelity had several million more new account holders, a lot of them young. They had the relief checks, they had time. First of all, have those investors generally remained active?
Not only have they remained active, they're still coming to join our platform, and that's evidence that in Q3 alone, almost half of our net new retail account openings were in this demographic of young investors, 45%. The other thing that really struck me personally and struck us, that 83% of new IRAs were also by this demographic. That is an increase from the same quarter a year ago. So I think those are pretty powerful statistics. The IRA one in particular, to me, what's really telling about that is my point earlier that this generation is taking action. It's not just about the education, but it's actually taking that step forward. And, given, as we were talking about the retirement industry, right, which is much more about long-term planning, to see a younger generation take action so early in their life, thinking more longer term. I mean, I certainly, am embarrassed to say that was not me at that age. And so just, really, really terrific. And I think, the industry overall is doing a great job to continue to democratize.
You said you're embarrassed it wasn't you at that age. I'm depressed it wasn't me at that age. Yeah. Because I see my nieces and nephews opening accounts 14, 15, already starting to think about their first house at 2021. And I'm thinking, okay, so much smarter. By the way, Fidelity just launched its crypto platform. I know we're not in the crypto space, but it seems like this is something also that's always going to remain an option that they demand, along with other asset classes. They generally expect more.
Yeah, I think, for us here at Fidelity, constantly ensuring the power of choice, and whether that choice is in product selection. I really appreciate what you were saying earlier, thinking about how, the retirement industry and how this generation will think about retirement, having power of choice in that, and having power in how you want to do business, which is about choice of channel, is also, I think, increasingly important.
I want to ask you each about how the pandemic affected innovation at your firms, because we saw the increased digitization everywhere. Also, as a reminder, as industries change, they grow, they decline. We saw with the EV presentation that those trends change. But finance is constantly growing, no matter what. It's something that we all need. So let me start with you, Vinny, on how the pandemic impacted what's happening at Voya.
Yeah, so pre-pandemic, it'd be almost, and I'm talking pre-pandemic, 2 weeks before the pandemic, you probably we would never have imagined that we could all work successfully together virtually. Right? It just was not even on the radar. We had, sometimes you would work home or if you had something going on, but it wasn't really as pronounced. And then a couple of weeks in, all of a sudden we're collaborating, we're working together. And so I think this whole, and now 2 years later, obviously there's sort of this hybrid, semi-remote type of workplace, but it works, and it works really well. And our employees, our teams have gotten used to it. There's no substitution for face-to-face, but so many things that we can do that we didn't think we could do before virtually, we're doing, and it's working.
And Shar, I want to point out that in the early days of the pandemic, perhaps not so much for Nasdaq because it was already very tech forward, but we were wondering, are the markets going to continue? How are we going to make these things happen when people can't be there physically? I know that this must have been a time of high stress for you.
So across the organization, obviously we power many of the stock exchanges globally, so over 130. And obviously we were trying to think about it from a very global and inclusive perspective. So I think the other aspect of that that's a natural follow is the investors were trying to figure out how to look at those markets. And many had to rely on things. Yes, face-to-face is better, but they started looking at how can they leverage the data, how can they exchange information, how can they be connected and be able to have insight into their portfolios from a very detailed transparency standpoint, because we were very uncertain where things were going from supply chains to just the pandemic in general. I also think in addition to us really leaning in more, and probably as a momentum for our investors were seeking different insights from us, we also looked internally and were very introspective. So, I think I would echo the comments of hybrid work environments have really challenged and maybe even expanded our ability as organizations to grow. But in terms of investments, a lot of what we do is about workflow. And so Nasdaq spent some time really looking at how we do our workflows and trying to optimize. And that's one of the areas I've always found interesting about technology and investments, is that you can have the best investment strategies in the world, but if you don't have those operational efficiencies, it really can challenge the end results. So I think that's something we've learned internally, and we're looking to bring that to the customers as well.
Brooke, also Fidelity had to stay online as we saw this huge surge in demand with people at home investing. And I know several times over the past few years, since the start of the pandemic, Fidelity has announced plans to hire like 10,000 people to help service all these new accounts. But in your role in technology for personal investing, I want to ask you about how you're interacting with all these customers. Is it more virtual? Is it no longer my generation, or perhaps a little older, where we'd actually call up our advisor?
It's a great question. So first, let me comment. You're absolutely right. We've hired almost 30,000 people since the big pandemic began into the complex. And what's interesting about that is, almost 5,000 of them are certainly in the business of technology delivery, but many of those roles are actually client-facing, which brings me to really talk about this channel of choice and what we mean by personalization. So, Janet, a couple of things happened in the pandemic. Number one, for all of us, right, money has emotion tied to it because it's decision-making. It's very personal. So a couple of things. One is we amped up significant investment. You talk about digitization of service. The things that you don't need, you want to get done quickly, we need to be available digitally. So major investments, we revamped our mobile platform, significant investments in our web platform, virtual assistant. How do we make it as easy for all of our customers to do business with us? On the other side, while we were hiring more client-facing roles, people were actually calling us, which is why we needed to, be there for them and actually hire into the complex. Why is that? Because there were a lot of, really difficult life moments in the pandemic. There was a lot of hardship in the pandemic. And those are really, in our experience, personal conversations. And then, of course, because we were all virtual in our investor centers as well, in that case, what was really great for us and helped us scale our business was that we were able to meet with clients virtually, right? You couldn't come into an investor center. So now as we kind of look forward, that has really scaled our ability to meet with customers in the channel that they want at a moment of need. And the other thing that we've learned is, each one of us is unique. So how we want to do business, what you might want to do on a mobile device could be different than an in-person conversation, could be different than an extended platform. And having that kind of flexibility to really meet a diverse set of customer needs is something we really leaned into in the pandemic.
We are now down to our last 5 minutes of this panel and of this morning's event. So I would like to ask each of you, I'll start with you, Vinny, about the horizon, the challenges that you see coming up, and how you think your business will evolve in the next 5 years.
Yeah, we spent a lot of time thinking about that, Janet, and I think we started touching on some of the technology, and that's why I was so interested to be here today. I think when it's not only importing and developing new technology to help our clients win in terms of our investment performance, it's about how we utilize that technology across the whole platform. So it's for example, not just an AI, machine learning driven fund, but how do we use those tools and techniques to drive better performance across our whole platform for our clients. And I think we spend a lot of time now thinking about the next 3 to 5 years and how that's going to evolve in a world where we might have virtual analysts sitting next to human analysts. And I think it's really exciting. I think it's a world that's opening up to us more recently, but certainly in the last decade has really taken off.
And we should also remember that as we bring in these technologies, the best technologies are almost hidden. They run without people really noticing them, and they do hold the promise of improving the job experience for everyone who works at these respective firms, because hopefully the jobs will become less tedious. Shar, with Nasdaq having to deal with so much information on a daily basis, I know automation was part of the founding story of Nasdaq and will be so in the years ahead. What sort of evolutions do you see coming at the exchange?
Sure. I actually believe, building on what's already been said, it's going to be about the analysis itself. We're talking a lot right now about artificial intelligence and what you're saying, that we're going to have virtual analysts alongside the human capital that works in the industry. But I think we're spending time also thinking, I think in the horizon it'll be, you've got data coming in from all different sources. You've got some data that is sustainable or ESG related. How do you analyze that in a way? And how do you take it across different types of asset classes that have yet to be developed? So I look forward to spending just as much time as we're talking about the technology developments, as much as what we're doing with the impact of that.
And Brooke, something that has happened at Fidelity, if you own an account at any investment house, more and more information is being given to the individual investor. I didn't think 30 years ago, I'd look at the entire book of a company and their debt and their earnings and going back several years, who else owns them, et cetera. And this is something that it appears that there's going to be more and more information available in the future, too.
100%. I think as we were talking earlier, Vinny, you were talking earlier about the power of AI. So a few things about the future. Number one, to your point, Janet, I think the proliferation of data will continue. What's important about that is two things. Number one, speed of information, where I think, AI powering that becomes really critical. But number two, insights. It's not just about the information, but how do we create personalized insights for investors that are real time? The second thing, just as we think about the future, I mean, if we've learned nothing in the last 3 years, I speak for myself, how unpredictable and just fragile, right, the world is. And I think we still have a lot ahead of ourselves in terms of geopolitical climate and world conflict. We have the elections coming up. The point being that there will always be unpredictability. But the criticality of education, having a plan, and having somewhere that you can go, right, to have those conversations and make decisions are things that we have really found to be most critical in actually helping to get through that unpredictable volatility. So a little bit of expect it to continue, but how do you sort of plan for that future and then have the knowledge real time at your fingertips, which is where the power of technology comes in, so you can make decisions that are best for you and your loved ones.
Thank you so much. We are at time. I really appreciate your incredible insights today, Brooke, Sharmila, and Vincent. Thank you so much for
Thank you,
joining
Janet.
us.
Thank you.
Thank you.